products, STP, SIP, and lump sum and switching. I think most of the times people shouldn't. Once you have decided on a journey, or the only time when you should look at things are when your goals change. Your horizons change, your cash flows change. These are all the times when you will have to look at things and probably do course correction. Otherwise, just because, something is not doing well for a shorter period of time, that's not the reason to change.
Hello and welcome to Market Pillars Uncovered, the education series where we bring you powerful insights from leaders shaping India's financial ecosystem. Today we're joined by industry veteran Mr. Madhu Nair, CEO of Union Mutual Fund. Mr. Nair has had an impressive career spanning more than 26 years, having worked with marquee organizations like HSBC and Invesco. Union Mutual Fund is sponsored by one of India's most renowned public sector banks, Union Bank of India, and by a more than 100-year-old Japanese company, Dai-ichi Life. In this episode, we'll discuss the less explored concepts of solution-oriented funds, fund of funds, how to choose the right mutual fund, Union Mutual Fund's offerings, India's economic outlook, and 3 high-growth industries of the future. Hi Madhu, thank you so much for joining us on Money TV today.
And thanks, Takarunya, for having me here. It's my pleasure.
So let's start with zooming out a little bit and taking a look at the big picture, the Indian economy. How is that likely to shape up by 2030? How are we set to end this decade?
Thanks a lot for asking, about 2030. Normally when I meet, people talk about what's going to happen next 3 months, 6 months, 1 year. So difficult, we are not fortune tellers. With our experience, we try to I wouldn't say extrapolate, that may not be the word. At least try to presume something, this is the way things are going to happen. But coming back to your question, I think very interesting. I think it's looking very, very positive. And there's nothing new about it when you look at history, because it's very important to understand history before understanding, stock markets. And when you look at countries like US, Japan, China, everywhere there has been a super cycle. Generally, the super cycles last from 20 to 40 years, depending upon, how they go through the super cycle and how the country progresses. I think it is India's time. And it's not that it has started today. It started, my sense is, almost 20 years back. And that's why, I thank my stars. You started at a time when macroeconomic story actually started.
So you were at the right place at the right time.
You can say that. But no credit to me on that. But and that's how that generation entirely benefits, and probably the next 2 generations. So coming back, I think 20 years has already passed away. But the next 20 years is going to be even stronger. So just imagine like this, you've actually taken so many years to build a $1 trillion economy. And now we are at 4 trillion in the last 5, 7, 10 years. And this 4 to 25, outline Viksit Bharat by 2047, give here or there, depending upon what analysis you read and what projections you do. India would be anywhere between 25, 30, 35 trillion dollar economy from what we are talking about, from 4 trillion. So I think the trajectory is looking very, very strong. And the other thing is, there is economic growth across the world in certain pockets. But we are not a small country. The size itself makes it very, very interesting. So compare it to an elephant who can, probably run at a decent speed. The impact can be much, much more. So looking, very, very positive. And I think stars are aligned. So when you look at, just think about country as a company and look at the balance sheets, and I think government balance sheet is looking very fine. Corporate balance sheet is looking very, very fine. Household balance sheet still, we are not leveraged actually. So unlike a lot of Western economies, etc. So I think we have all the ingredients We are coming off from a high interest rate cycle to, probably a low interest rate cycle in the next few years, low inflation, and with a moderate to better growth compared to the world. I think everything looks fine from an economy perspective. But doesn't mean that, it will translate into stock markets all the time. There will be phases. Yeah, broadly, over a period of time, it should align. And this is a period wherein if investors stay on, which is very, very important, and that depends upon them, because I think returns are directly proportional to the investor behavior. Nothing else. So if they stay on, I think markets can offer you something which I can tell you. It could be an intergenerational wealth creation opportunity for people.
Amazing. And that's, you've started on a very promising note. So you're sitting on a pile of research. Of course, you're, speaking out of your experience and all of the know-how that you have. Now, in this last 5 years of this decade, as we step into 2026, towards 2030, what will be the big drivers, the big sectors to watch out for that will actually propel this exponential growth you're talking about?
Sure. Interesting, from time to time, which sectors looking promising and what are the growth opportunities. So there are two parts to it. I'll address the first part and then get into the second part. First part is on the economic story and how, sectors are looking. So I think India is witnessing an all-round growth. So that makes it more difficult for fund managers because stock selection becomes very, very important. You really need to, there will be growth available and opportunity available in each segment. I'll just dissect it further. So for example, when you dissect our GDP, you all know that, it is primarily driven by consumption. 60-65% of the GDP would be whatever numbers you want to add, private consumption plus government consumption. Then you have the manufacturing part of it. Then you have the export story, etc. But predominantly driven by consumption. And the last 5-7 years have not been great for consumption, particularly. And there is a reason for it. When you look at this government, when this government came into power in 2014, the entire focus was on building infrastructure. If you look at, all the initiatives, you take money into the government balance sheet and then spends it out from there. And that's wherein, infrastructure development happened. And that's maybe one way to, from an economic perspective. But now look at the shift from last year onwards. I think it's a very conscious shift. Started with the tax relief or tax cut by taking up to 12 lakh exemption. And then the GST one. Then now we are talking about 8-pay commission. All of this, and with lower interest rates and good monsoons, my sense is are ready ingredients for moving the current consumption. So consumption is happening. But if you want to get this consumption into a next orbit, some tectonic shift has to happen.
Yeah. So how is Union Mutual Fund reshaping or unlearning and then relearning the new trends? What are some, exciting services that you're offering beyond the bread and butter, whether it's fund of funds or solution-oriented funds and so on?
Interesting. So I think first, let me talk a little bit about what are we. I think if investors wants to understand us, what they should understand what's our DNA and why we do what we do. Very, very important. And we are a joint venture between Union Bank, which is one of the largest public sector bank, and Daiichi, which is one of the largest insurance and asset managers based out of Japan. And that's wherein we want to act as a bridge. How do you convert this India's brilliant opportunity, I would say, Amrit Kal, for the next 15-20 years and convert it into creation of that into, benefits of Indian households by wealth creation of theirs. So that's what we are going to do. And for that, what are we doing? We are going to create products which will be managed very well. That's wherein we have put in our entire efforts on building up a world-class investment team, build products. And also to reach them. Very, very important. Because today also, when you look at the mutual fund penetration, it is hardly anything. We have got 5 crore investors, which can be easily 25 crores over the next 10, 12 years. And also when you look at a metric called per capita AUM per household, that's very, very low. That also can be very big. So this is a tremendous opportunity to convert this India's Amritkal into household Amritkal, and that's wherein we want to position ourselves. But the problem is just by creating products and reaching to people will not ensure that, because people will not make money or create wealth if they don't stay through this entire journey. So it is very, very important to handhold them, communicate to them, and launch products and give them that investor experience so that they can stay through the journey. That's what we are focused on. Coming back to what kind of products, yes, I would say we are trying to solve a problem. So I've already told you what is the problem and what are we trying to solve through conversion and acting as a bridge for that. So we call all our product as solution-oriented products, because all our products fits into some bit of solution. Because personal finance is something very, very personal, and so there is a problem at every person's end when you look at finance, and our products will find its way as solutions. But from a SEBI parlance, when you asked about solution-oriented, yes, we are pretty excited about it, because what it does is that it takes away that entire emotional biasness from the investor, which is very, very important. For example, we have a retirement fund, we have children's fund. So you are actually attaching a goal to it. So when you are attaching a goal to it, your focus is on goal, not on how much returns are you getting on a year-on-year basis. The moment you look at that, I think wealth is not getting created. That's for sure. But if you're looking at a goal, and because finally that's the purpose, right? If you have a goal and if you achieve it, you're done. It doesn't matter that you get 13% or 12% or 14%. But the moment you start comparing, I've got 12, my neighbor has got 14, then that's going to be a disaster. So that's where solution-oriented funds play a role, because they focus on the solution and gets you, like a horse blink towards that journey. So that's why I love them. So we are launching many of it. Fund of funds is another exciting product. We'll talk about it during the show, but that again takes away the emotional biases of the investor, because you give it to the asset manager to do things.
It's a very interesting approach. I want to circle back to fund of funds as well. You've explained solution-oriented funds, but what about fund of funds, and why are they better or different from regular mutual funds in the market?
Sure. No, I think it's not new product. I think we were early on, 20 years back, had launched fund of funds as an industry. But due to taxation issues, it never got popularized. When you go to global markets, fund of funds they call it as wrappers, multi-managers, wrappers, one products which will invest into different funds, etc. And give you one single, convenient kind of holding. Otherwise, when you look at people, they will hold 100 funds, 50 funds, all of this. And over diversification doesn't actually mean anything to the final returns of the portfolio, because beyond a point, it just, because there is an optimal level in mathematics, and beyond a point, it just gets disturbed. So fund of fund is a great concept to bundle solutions, especially to investors who are new to the industry. Also, I think it is applicable to all, because instead of having 5 funds in your portfolio, why not be with one manager and let him select the entire thing? Second is, I think taxation is a big advantage, because when you buy into a fund of fund scheme, because it's a part of mutual fund and it's a mutual fund scheme, I think the biggest advantage of mutual funds is we are a trust, right? And what it does is that whenever we do any buy and sell, whether it is stocks or whether it is funds in between, we don't pay any tax. So if an investor, for example, you would have invested in 5 funds and you move in one fund to another fund, you will tend to pay tax.
Yeah.
Wherein when the mutual fund does this inside, there is no tax. So it's again, a very, very good point. And mainly it is convenience, and your experts are managing your entire fund portfolio. So I think fund of funds have its own merit. And also from a cost perspective, with regulatory guidelines you can buy into low cost plans, and that reduces the cost. So all of this helps, but again, investor needs to look at as a complete portfolio kind of approach rather than singling out one fund versus another fund, because that's the mistake people will do, because certain periods, certain funds will do well, somebody will lag behind, and then you try to get out of things which are not doing well and get into other things. It's like changing your car lanes in the traffic signal, and finally, it finally doesn't matter. So similar thing can happen with fund of funds, because at certain points of time, it may not be the best fund performing in your portfolio because it's a collective portfolio. But that's wherein people need to stay on. But tremendous benefits, I would say, which is very, very difficult.
You've literally segued into the next question that I was, going to ask
Sorry,
you is about switching and about moving funds.
Yeah, but it doesn't seriously make
when
any...
should one do it and when should they not do it? Because it's, again, like you said, it's very personal, right? One size fits all does not work when you are working with individual portfolio. Let's say this investor has entered the market, has, invested in certain funds. When is the right time to relook where you invested in, and then perhaps switch? Because STP is also a thing, right? Systematic transfer plan. So when should you deploy something like that, or if should you do it in a combination? What works?
So I'll come to all 3 points. STP, SIP, and lump sum and switching. I think most of the times people shouldn't. Once you have decided on a journey, the only time when you should look at things are when your goals change, your horizons change, your cash flows change. These are all the times when you will have to look at things and probably do course correction. Otherwise, just because something is not doing well for a shorter period of time, that's not the reason to change, or something is giving better. For example, let's say gold has done tremendously well in the last few years. But is it the time to go extremely high on gold as an asset class? It may, probably end up in disaster. But gold has to have an allocation in the portfolio? Yes. Modern portfolio actually states that, beyond 18% of gold doesn't serve any purpose. But yeah, at some point of time, especially in the last 20 years, people who would have made portfolios, gold would be lacking in, because gold has never done well in the last 10 years before the last 5-7 years. So there would be obviously shortage. So you need to get to that 18% first allocation of gold. So, unless and until your goals change, your asset allocation needs some warranty changes, your cash flow changes, that should be the reason when you want to, probably rearrange a little bit.
And if and when one does, between one-time STP or combination, what should be the approach?
That's a very interesting question. So I think how to build wealth, I think SIP is a time-tested one. And why SIP is because you don't have lump sum too much to invest. So you probably are getting cash flows on a regular basis. So how do you create wealth? I think this is one of the best methods, because this is what does SIP do? It actually, what does Warren Buffett say? Buy low. That's what one of his this thing, and that's what SIP does, right? At every point when the market goes down and it buys more and more units. So you actually have to go through that entire down cycle. That's the brilliant thing of SIP. But you need to stay on. That's very important, because the first 5 years of SIP, your contribution would be 80-90%. The market would be only 10%. But at the end of 20 years, I think most of the times, what we have seen is that 80-90% of the total wealth created would be market, and only 10% would be your contribution. So SIP is a very, very strong way for people who have got cash flows in a staggered manner. Now, STP and lump sum is a very classic debate. That's wherein at Union, our fundamental philosophy is fair value spectrum. We look at fair value very, very closely. And that's what I said in the initial part of the conversation itself. Finally, the returns are directly proportional to the valuation at which you enter. So what we look at is, we look at 5 zones of value, starting from very attractive to fair value to expensive to very expensive. These are the 5 ranges of markets. And you will find markets in any of these 5 ranges at any point of time.
So we've talked extensively about investor journey. Let's talk about your journey, your career as well. It's been truly inspiring. We've seen you, been associated with numerous large brands within the BFSI space. So what has shaped your career? And if you want to talk about one turning point that defines or ties all of it together.
So I think there is no one turning point. I say, I think I started at a good time. I think that's very important. Macro story. So I think luck is very, very important, because when you start at 1998 and 2000, that's where the story really started unfolding. But was it a straight line? No. So it has gone through its own gyrations. I've seen some bit of market cycles. And every market cycle actually teaches you a very, very strong lesson. So for example, I'll tell you, when I started off, IT was in the boom. And we used to have IT funds in the industry. And as a newcomer into the market, I've also made mistakes, because you start reading, you have so much data, how to look at it. And without understanding the past cycles, you tend to, go overboard. And that happens with IT, in 2000, and then you've seen an IT debacle. And then, that's the time when, you understand that, everything in excess finally leads into things. So these are all some of the learnings. But broadly, if you want to ask me, I think I've worked with very strong organizations, which is, let's say, Kothari Pioneer was the first startup, because I think today it is an era of startups, and because we had started this, and this was the first private sector mutual fund. And there, I think innovation was the key, because mutual fund industry was already big in the Western countries, and we were actually importing, that entire concept into India. So, everything was innovation at that point of time. Then you actually did it with Kotak. Kotak, again, how to build businesses with value for money. With a very strong, tight balance sheet, I would say, and build the business and scale it up. Then went on to build Religare, which finally got into Invesco and became Invesco. And that was an entrepreneurial kind of journey, because you were all in building a new brand, and which means your personal credibility was on stake, rather than marketing larger brands. And how do you not make any mistakes and do the fiduciary responsibility? So that's what we did at Invesco. Then HSBC was a very, very different experience, because a global giant, trying to get into Indian asset management space. But we were able to build up, by getting and collaborating globally as well as the thing. So various things. And then finally, taking over as CEO of Union Mutual was a great opportunity. That's where in all this experience across sales, distribution, products, investment, operations, finally culminates and then get into something which can, closely, I would say, close to the heart kind of mission. Because finally, as I told you initially also, it is good to see India progressing. Maybe few people, all of us will make money, a lot of money. But if it doesn't translate across inclusively, then it has no meaning. And that's wherein, Union Mutual Fund can play a big role. How to reach even to the lowest households in terms of strata and create some wealth for them and get them as the beneficiaries of this India growth story. That would be very, very fulfilling.
Great. On that note, we'd like to wrap it up. Thank you so much, Mr.
Thank
Nair,
you.
for joining us today.
Thank you. Thanks a lot. It's been a pleasure. Thank you.
That's all for this episode of Market Pillars Uncovered. Do not forget to like, share, and subscribe to Money TV for more such insightful conversations with India's leading market voices. Until next time, invest smart and stay informed.